My name is Kevin Steele, Fractional CFO with over 18 years experience in finance. And today we're going to do a deep dive in terms of what's the difference between an accountant and a fractional CFO, and when you should actually get a fractional CFO, because that's a really important decision. So let's think about your car's dashboard. It's got a mileage indicator, right? That's historic information on how many miles you've driven. And an accountant's all about giving you historic information. Another piece of info on a dashboard is a GPS. A GPS will plot to where you want to get to. That's what a fractional CFO does. It plots the path forward. So accountant, backwards looking information, fractional CFO, mapping the path forward. So now what we're going to do is we're going to dive a little bit deeper into the differences of an accountant and fractional CFO. And what I'm going to do here is share screen and run through a nice example for you. So you will see this pyramid here. So let's go from bottom to top. So at the bottom, transaction processing. This is primarily what a bookkeeper does. So in your Xero, your QuickBooks, your Sage, they need to reconcile the transactions, raise the sales invoices, make sure all the underlying financial information is correct. And note that unless the underlying financial information is correct, then the reporting falls down, the budgeting and forecasting falls down, the entire pyramid falls down. Finance is garbage in, garbage out. So transaction processing is very, very, very important, and that's primarily what a bookkeeper would do. Next, we move on to reporting. This is what an accountant does. So they take all the information that the bookkeeper's done in the transaction processing side of things, and then they'll prepare things like your payroll, your tax returns. They'll give you tax advice. They'll do all your government filings. They'll maybe produce some historic information on your profit over the last 12 months, your performance over the last quarter, that kind of thing. But it's primarily historic looking. And the next part is where fractional CFO comes in. So fractional CFO focuses on three key things always. Number one, budgeting and forecasting. Number two, analysis and insight. And number three, strategy. So just to go into these into a little bit more detail, fractional CFO at step one, they will take the information from the accounting system. So your Xero, your QuickBooks, your Sage, that the bookkeeper and the accountant have made sure is very clean and tidy. And then they will start to build some budgets and some forecasts. So we take the example of a company that has a financial year end of January to December. What we would do first of all is we would set a budget for the year from January to December all the way through. So we plan out all the sales, all the cost of sales, all the expenses, any potential tax liabilities, etc. And what that will be called is our master budget for the year. So this is our best plan we can think of all the available information we have at this point of time. And forecasting, this is what we do on a monthly basis, because we can set a budget at the start of the year, but it could be completely different 6 months into the year because of new hires, new contracts, new assets purchased, etc. So a budget is usually done at the start of the year, while forecasting is an evolving thing that we do every single month. So what I do with my clients, for example, is every month we meet up and we have our forecasting meeting and we say, okay, what's happened in the business at this moment in time? Have there been any new staff hired? Have there been any costs cut? Have we purchased any equipment, etc., etc.? And we update our forecast every single month. And then we use that figures to set little targets each month. So for example, if we're in February and we're forecasting for March, April, May, we might say, okay, based on all our information or sales pipeline, we think our revenue is going to be 60,000 in March, 70,000 in April, and 80,000 in May. And then once we get to each month, March, April, and May, we will compare what we thought would happen to what did happen. And if we have a small gap, so we predicted we'd make 60,000 in March, but we made 59, great, pretty accurate. We're 1,000 out, not a big deal. But if we had forecast to make 60,000 in March, but we actually made 5,000, that means our forecast was wrong by 55,000, which means one of two things. Number one, something crazy's happened in the business that was completely unforeseen. Or number two, we have our assumptions wrong in our forecast, because the gap should never be that big. We should always try to get as accurate as possible to what we thought happened to what actually did happen. And then that comes into the next pyramid up, analysis and insight. So this is where we dig a bit deeper into our forecasts and we figure out, why are we not so accurate on these forecasts? And we get some more information, we tweak things, and then we take things a step further and we actually identify, okay, what is driving the profitability into this business? What levers can we pull to reduce costs? Or alternatively, what levers can we pull to increase revenue? So to increase revenue, we can maybe increase our prices. We can sell to more customers to reduce costs. We could maybe cut some of our software subscriptions. That's one common thing. And a lot of companies, software subscriptions every month can keep building up, building up, building up. You forget to cancel them. Then all of a sudden, you're paying £6,000 a month for software subscriptions and half of the team aren't using them. So we really kind of do a deep dive and look what kind of levers we can pull to either increase revenue or reduce costs. And then we come on to the top strategy. This is what a fractional CFO does primarily. So a lot of people say they're fractional CFOs. They're not, because they don't focus on strategy. Any good fractional CFO does one thing. They link finance to strategy. So the CEO of the company may have an overall strategy which breaks into 1, 2, 3 main goals. The fractional CFO's job is to analyze the finances and link them directly to the strategic goals of the company. That's absolutely key. And once the job has been done well, the budgets and forecasts should flow all the way through from there. So just to recap on our pyramid, transaction processing down the bottom, that's what Bookkeeper does, reporting, that's what accountant does. And then fractional CFO looks at the budgeting and forecasting to get analysis and insight, which then helps link the finances back to the strategy. So now you can see the difference between an accountant and a fractional CFO. But perhaps the hardest question to answer is for founders, when should you actually hire a fractional CFO? That's what we're going to cover now. So you need an accountant that's non-negotiable. You need to stay compliant with the tax authorities and you need to have good backwards looking information. Otherwise, you will be filing incorrect financial information, which is never good as that can result in all kinds of trouble and tax investigations. But when do you need a fractional CFO? What I've found after working as a fractional CFO for over 6 years is that first thing is there is usually a level of income. And that level of income is if you're below 1 million in revenue, you probably don't need a fractional CFO, in my opinion, unless you are a fast-growing startup. Then you need a fractional CFO. If you're above 20 million in revenue, you probably need a CFO, perhaps on a part-time basis, that can maybe spend 20 hours a week or so in your business, because a fractional CFO works with multiple clients at one time. And if you're 20 million, your business is going to be a lot bigger. So you probably need somebody that can dedicate a bit more time than a fractional CFO. So 1 to 20 million is the sweet spot, in my opinion, if you're looking for a fractional CFO. And outside of all the forecasting, the analysis, the strategy, fractional CFOs also do a number of other things. So one of those might be mergers and acquisitions, for example. If you're looking to sell your company, or indeed you're looking to buy a company, fractional CFO can help you with that. If you have an internal finance person you're looking to upskill in your business, fractional CFO can help with that. So if you want another adult at the table, fractional CFO is a great shout as well. One thing I have learned in the past is that business owners can often feel a little bit isolated. You might have a solo founder or you might have a couple of founders, but they don't really have that another adult at the table who's worked with lots of different businesses of similar sizes who can come in and give them that non-executive support, bouncing ideas off, not just finance stuff, but maybe people issues, maybe wider strategy issues. Another adult at the table is a really big benefit for clients. The accountant and the fractional CFO, they're not actually competitors, they work together. Without the accountant doing their job, the fractional CFO cannot do their job at all. And with all my clients, I work very, very closely with their current accountants because it's really, really important. If you remember, we linked back to that pyramid before where we had at the bottom the transaction processing, then we had the reporting, and then we had the fractional CFO work on top. So really, really, really important to distinguish that an accountant and fractional CFO work together. So you don't need an accountant or a fractional CFO. you need an accountant and a fractional CFO. And you'll know a good fractional CFO because they'll be able to establish and maintain a great relationship with your current accountant. And for any reason, if a fractional CFO comes in, they might actually say to you, your accountant's not as good as you think they are. One of the problems is that anybody can call themselves a fractional CFO. Even somebody with no accounting experience or finance experience could go, hey, I'm a fractional CFO. But the next video is all about spotting those kind of people. What we're going to cover is the exact questions that you should be asking any fractional CFO, which will help you spot a good fractional CFO from a bad one. Look forward to seeing you in the next video. Click here.